Hello, and welcome to the first CAP STRAT this week of 2024. We've got some exciting market news to get into, and then we are going to be taking a deep dive into our investment framework for a specific asset class. So we'll get to that in just a minute here, but let's start with returns. We've got the equity returns up on the board here. Mike, obviously 2023 is now in the books.
All is well that ends well. I mean, you look at these numbers and you think about everything we went throughout the year, right? Recession fears at the start of the year, the Fed continuing to hike interest rates through multiple bank failures, the largest bank failure since 2008. You have China's economic recovery failing, I guess, coming out of COVID. But you look at those returns and it ultimately didn't matter, not to mention risks of default, U.S. government debt, a government shutdown, all of those things. So 2023 ended up being a very strong year for equities. You look at the difference in return within U.S. large cap equities, large value stocks up about 11.5% versus large growth stocks up over 42%. The overwhelming majority of that driven by the Magnificent Seven. And then if we move over a couple slides, we look at the 2-year numbers, they're actually almost identical. So it just shows the outperformance of value over growth from 2022 was just reversed out in 2023. And then, we had talked about towards the end of 2023 how the market had gotten to a point where, in our view, it had fully priced in this idea of an immaculate landing. Obviously the immaculate landing still needs to play out. But markets move ahead of that, and based on numerous metrics, it looked like the market had already priced in cuts, all of the cuts in the cutting cycle. And so with that, it appears the market woke up on January 1st, 2024 and said, hey, this rally has gone a little bit too far, and gave back a decent amount of those gains. Small caps down almost 4%, large growth down 2.7%, but just a very broad sell-off, really the opposite of the rally we've had since November 1st coming through here to start 2024.
Yeah, and you referenced it there. Right now is a very interesting time to be looking at a 2-year time horizon, right? We just talked about the strong returns, particularly in large growth for U.S. equities in 2023, and how that kind of undid some relative underperformance. So what we have here, looking into cumulative total returns since 1/1/22 for various areas of the global equity market. And we're comparing that to cash, this nice smooth ride right here over the past 2 years. What's important for our viewers to see on this chart?
Well, you look, the winner is the Magnificent Seven. You're up about 10% over that entire time period, cumulative, so not annualized. Just barely outperforming cash. And keep in mind, cash right now is yielding 5.25% to 5.5%, but it was not yielding that the entirety of this, right? And then you think about the narrative around the Magnificent Seven right now. The prevailing narrative within the market is these stocks are, they're Teflon. They're the biggest, baddest companies in the world. You want to own more of them. They never go down. But you look at this price chart, I mean, during 2022, they were down over 40%. From the beginning of 2022 through December. And then, came back a little bit in March when we had bank failures, and then the overwhelming majority of the gains happened from sort of mid-March 2023 through July. And since then, they've just sort of moved up higher in line with cash. But when you look at it from this perspective, it's just so different from the prevailing narrative out there around the Magnificent Seven. And then you look at other areas of the equity market on a year-over-year, on a 1-year look-back basis, you would say, wow, growth stocks, the blue line, significantly outperforming value stocks, the green line. But over the entire two-year time period, they're basically in the same spot. And look at how much volatility you had owning something like the FTSE high dividend yielding stocks in the U.S. You rarely during this time period were down more than 10% from any given period. And then finally, you see China. We talked about that earlier. Expectations of a reopening recovery late in 2023. as they very sharply eased COVID restrictions and now just on a straight line down and to the right since. So it has been far more volatile of a 2-year time period than trailing returns would lead you to believe.
Yeah, important to keep that in mind as we're sitting here in January 2024, right? These stocks that seem incredible, can't go down, just to the moon, right? They have gone down, and they have gone down recently, and they are significantly outperforming most other areas of the global equity market. So a couple of unique aspects there.
Yep.
All right, let's get into fixed income. Not bad, seeing some green for 2023 for the full year for fixed income.
Yep. U.S. Treasuries, the Bloomberg U.S. Treasury Index, up 4% for 2023. As we got into October, that index had a negative return year to date, and the sentiment around bonds was probably the worst since the early 80s. And that immaculate landing regime that the market started to shift to led to some strong gains during Q4. And now we have a positive return for the year, 4%, not bad.
Yeah.
Other areas of the equity market, if you had a shorter duration and higher credit risk, you were generally better off. But once again, if you look at the year-to-date column thus far in 2024, reversing a good chunk of those gains.
Yep. And then we'll wrap up from a returns perspective on the alternatives front. Here we get a little bit more of some Christmas colors, some red and green. Anything to note from an alternatives perspective?
Commodities definitely had a tough year in 2023. You see down 8%. Energy was the biggest laggard, if you will. And then year to date, you see energy up 4.5%. So a lot of volatility there as well. But 2023, once again, you look at the trends, positive returns for equities, fixed income, negative returns for commodities, the exact opposite of 2022. Right. 2022 was negative returns for stocks and bonds, positive returns for commodities. Yep. So once again, just sort of like a mirror image year.
Yeah. So we had one side of the coin in 2022, the opposite side of the coin in 2023, and now we're into 2024. So over that 2-year time period, you've got Magnificent Seven slightly outperforming cash. And so the question kind of becomes, which one's better going forward, right? So what we wanted to do here today is go through our investment framework for the large growth asset class. And we can, the first part of that is through a valuation lens. You want to walk through that valuation framework?
Yeah, when we think about valuations within our investment framework, we're looking at 3 things. We're looking at distance from trend. So that's what you see here, the lines in the top chart. The dark blue line is the large growth return index. This is on a log scale. Normally financial assets go up in an exponential fashion. Compound interest is the 8th wonder of the world. So we flatten that out by putting it out on a log scale. It makes it much easier to interpret. So you see the return index in dark blue relative to the long-term trend. That trend is since 1960. So when we think about valuations, first thing is, are we above trend, expensive? Are we below trend, cheap? One of the biggest examples of being above trend and expensive was the lead up to the tech bubble burst in 2000. That was the largest distance above trend we've ever seen, right? But you can see that leading up to the tech bubble, we were above trend for multiple years, right? So you can't just have valuations be based on how far you are from trend.
Right.
We also have momentum. Momentum is very important, more important for some asset classes than others. For large growth, it is important. So a high and rising regime, meaning I'm above trend with positive momentum, that's actually not that bad, right? So that's the second factor. And then the final factor is taking all of that relative to the yield on cash. If cash is your risk-free asset, you should think about valuations of every asset relative to the risk-free. So you take those 3 things combined and look at where we're at today. We're at trend right now. We were below trend in 2022. Since this rally in 2023, large growth is now at its trend since 1960. The momentum is pretty good, right? So those things aren't giving a big warning sign saying valuations are expensive. What's changed is cash yields are the most attractive since 2007. That is what's driving, you see this red shaded area, this expensive valuation signal. So what we do is we take those 3 factors into account. We look at all of them since 1960 and we percentile rank them. when they result in being more expensive than 75% of history, right? So 75th percentile or worse, then that is a valuation signal that the asset class has turned expensive. And right now, large growth, we would say, is expensive. That doesn't mean you go out today and you sell all large growth, right? We know the valuation signal can be early, like it was in 2000, but it is cause for concern, right? Especially when you look at cash yielding 5.33, it's factored into the calculation, but that's your alternative, a risk-free over 5% compared to a very risky, very expensive on a forward earnings basis, whatever multiple you want to use, large growth asset class.
Yep. So we've got our valuation signal triggering as expensive right now, right? But as you noted, we're not just going to take that in a vacuum, right? The other side of that analysis is the macro environment.
Yep.
What we look at, we call it macro X recession, right? So looking at some of those framework items that we talk through on a regular basis: economic growth, liquidity, inflation. And so we've got a similar chart here. You want to walk us through what's going on in the macro side?
Yeah, for every asset class, we take those three macro pillars: liquidity, inflation, and economic growth, and we forecast out 12 months out, are they going to be high or low, rising or falling? And how those all are expected to play out, that can mean different things for different asset classes, right? For large growth, what you see throughout time is large growth equities are not particularly sensitive to inflation or economic growth. That's almost the point of investing in. These are high growth companies that can grow earnings theoretically in any economic environment. And inflation, they generally have pricing power with a big addressable market. So not particularly sensitive there. What large growth is very sensitive to is liquidity. And so that's why you see throughout this 30-year look back, you don't get many macro signals for an unfavorable environment for large growth going forward, because liquidity was plentiful pretty much this entire 30-year time period. I mean, it was a period marked by lower highs and lower lows in terms of the Fed funds rate. QE was invented during this time period. Really, the first time we've seen a significant macro unfavorable signal started in late 2022. And it was because, if you look at liquidity, we started to have the fastest deterioration, the biggest drawdown in money supply growth that we've ever seen, which was, of course, caused by the second fastest rate hiking cycle in history, right? So our macro signal triggered unfavorable. It sort of took a little bit of a breather as we got into late 2022, midway through 2023. And then now forecasting that liquidity is still going to be low for the next 12 months, you see we got another trigger of an unfavorable macro environment for large growth. Specifically, you can see this gray line is the macro percentile rank. So whenever the macro environment is in the 75th percentile or worse, that would be an unfavorable trigger. You see that towards the bottom. Right now we're at 76.5. So, that in isolation, it's not as bad as it was in 2022, right? And it would suggest you would want to be underweight large growth. You combine that with the valuations, and what you have is both of these pillars of our framework, valuations and macro, triggering negative at the same time. That doesn't happen often. In the past 30 years, we've only had 3 such instances where these red bars on the last 2 charts line up right with each other, right? So it's definitely something notable that we're factoring into how we're positioning portfolios.
Yeah, certainly. And just for clarification purposes, you talked about here, large growth, sensitive to changes in liquidity, right?
Yeah.
Triggering an unfavorable macro environment. This takes into account some sort of expectations for the Fed cutting rates and providing some additional liquidity, right? So that's even in light of that.
Right. That takes into account our forecast for the Fed funds rate, which is 4 cuts. In 2024, and then a continuation of quantitative tightening throughout the year. So it takes all that into account and how that factors into money supply.
Awesome. And we called this macro X recession. Of course, recessions are still important. So looking at our recession signal here for large growth, what's important on this chart?
So on the top chart, you see the reds and the greens. Those are our recession entry signals in red. And then something that we haven't talked about on video yet because there's been no need to, is once you're in recession, markets then typically start to rally while you're still in recession. So what you want is a recession exit signal, which is what we've created, which is basically, even though you might still be in recession, markets there's been full capitulation, a full flush of selling, positioning has all been cut to the bones, and now you've created the stage for equities to rally from there, right? Yeah. So you see that play out in 2008. Our recession entry signal was early. It was about 6 months early. And you can see that based on the bottom pane, we have the actual National Bureau of Economic Research recession indicators, business cycle indicators. So you can see our signal triggered before the recession was actually claimed to have happened. And as you can see, you see large growth hitting its lows right around March. Our exit signals triggered a little early as well. But overall, they sort of signaled that the market had bottomed even before the actual recession had ended. So that's how we think about recession through an entry and an exit signal. Our recession signal is not active. If it were to activate, that would be a negative thing for large growth. It's a good thing for some areas of fixed income, but negative for large growth. And then that's why we haven't had to talk about the exit signal yet, but that within our framework, once we get a recession exit signal, that is one of the most constructive times to go long risk assets and buy equities. Right. It's the most uncomfortable time. You sort of have to plug your nose and buy, but that's typically the best time to do it.
Gotcha. Well, thanks for that, Mike. So we ended 2023 by talking about the investment framework and our outlook for 2024. We wanted to walk our viewers through the framework for a specific asset class. We touched on valuations, signal expensive right now, macro X recession, unattractive, recession not triggering. Of course, we update these things regularly, and we'll report back to our viewers as this outlook evolves into 2024.
Mm-hmm. Yep.
And with that, we can get into the economic pillars of the investment framework. We'll start with inflation. We've talked a bit recently about core PCE, super core PCE. What's important to know on the inflation front?
Well, core PCE is the Fed's preferred gauge of inflation, and what you see in that green line for the first time during this cycle, there are some signs of victory, right? And this is what the market had gotten all excited about, right? This is why the immaculate landing started to get priced in, because over the last 6 months, on an annualized basis, core PCE, the price index, is up 1.87% annualized. So below the Fed's target. So there's victory, right? Now you have to it begs the question, if this is your inflation gauge and there are signs that it's below target, why are you not cutting rates right now? Why have you not been cutting rates this time, like for the past 3-4 months, right? And that comes into play when you look at things like supercore, which, as a reminder, supercore PCE, you take the core PCE, you just look at the services component, and you strip out housing. That is what everybody is worried about, because that is most tied to the labor market. It's the most labor intensive, and we actually haven't seen any progress. The lighter purple line is the 3-month change annualized. It's running at a 3.6% pace. We haven't seen any progress over the last 3 or 4 months. So that's where the tension is right now. The Fed doesn't want to cut too early because there are signs that the stickiest, most labor-intensive areas of inflation, you're not making the progress you need to make. And so there might be a possibility where they keep rates too high for too long, trying to squeeze out this last little bit of services inflation and create a recession. Or they ignore that, they cut too early, and they reinvigorate inflation. So that's the tension. That's what we think the market is going to start to recognize here, is those cuts in March, those are a little premature.
Yeah, that's the biggest thing I'm taking from this chart, is just the potential for a market disappointment as you're starting to see some of those core numbers, those core headline numbers, making a lot of progress, but the Fed saying, we're not so sure we've completed the job here yet. So from inflation, we'll get into economic growth. Any material updates from an economic growth perspective?
Not a whole lot. It looks like the Q4 GDP number is going to run somewhere in the 2% range and then slow from there. Not huge updates from the last time we spoke.
Awesome. And then liquidity, we talked about this as a particularly notable input into the large growth macro recession environment. Mm-hmm. How about liquidity? Anything we should update our viewers on there?
Very similar, where it shows a recovery in liquidity, but it's probably not going to feel as good as it looks. And you see liquidity sort of petering out at something like a 1.3% run rate year over year, change in money supply, which is, it's great if you want to bring down inflation, but that's a very difficult liquidity environment for risk assets, financial assets, equities in particular, growth equities, and also a difficult environment for real economic growth,
right,
as well. So
yeah. It looks like a lot of improvement, but it's still going to be the lowest value on this chart, right? Other than the 2023 drawdown.
Yep.
Awesome. And then we'll wrap up with our recession signal. We noted in the large growth review that our recession signal is not active. Anything in particular we're looking at here? Looks like the labor market continues to kind of move away from those trigger levels. Anything else we want to point out here?
Yeah, that's notable. And then we are seeing some signs of stress within interbank funding markets, interbank lending markets. That's not something we'll go into today. If we see SOFR over 3-month Treasury yield spreads rise something near 0.25%, be prepared for a very wonky discussion about why that's happening and what that means, but not today.
Cross that bridge when we get to it.
For sure.
Awesome. Well, that'll do it for us for this week. Thanks for tuning in, and if you have any questions or comments, please feel free to reach out. Thanks.